Hey everybody, Phil Hodgen here, and welcome to the monthly Hodgen Law PC International Tax Lunch. We do this every month on the second Friday of the month at noon Pacific time. You can listen in online through CalCPA. Thanks CalCPA for doing this for us. And if you're hearing my voice now, you're doing exactly the CalCPA stream, or we post this thing on YouTube later and you can watch it then at your own leisure. This month's topic is about expatriation. Uncle Sam looks at all of us as dairy cows on his dairy farm. They're for the milking, meaning he wants to extract tax out of us. And as you might guess, Farmer Sam does not like it when the cows wander off the farm and he can no longer milk them. And so for that purpose, when the farmer sees a cow wandering off, there's one last thing he can do, milk the cow one last time, and that means extract tax from him, her. This is expatriation. This is Sections 877 Cap A. It applies to U.S. citizens and green card holders. And if they want to log out of the system and leave the United States and the U.S. tax system specifically, as you might guess, there's a lot of paperwork, and if you're the wrong kind of person, there's a lot of tax to pay. So today, Deborah Rudd, CPA, who is with our firm, is going to talk about this. She's worked on a few hundred of these, so she knows them intimately, planning for them as well as doing the tax return prep and cleaning up messes. And so here we go. Deborah will give you the introduction to expatriation.
Hey everybody. So today's title is Expatriation, the Tax Consequences of Relinquishing U.S. Citizenship or Green Card Status. On slide 2, I have a pretty detailed outline of what we'll be talking today. First, there's going to be a general overview of how expatriation works, so that when we start talking about what's your expatriation date, are you a covered expatriate, and how you can make this situation a little less bad for yourself, when we get to that stuff, you'll have the context for what we're talking about. So once we go over the overview, I'll go into what's your expatriation date. And that is relevant because to be an expatriate, you must have had an expatriation event, and that event takes place on a date. And that date is sort of the dividing line in your life for tax purposes that you'll be using when you're preparing tax returns and also making life decisions. And then, are you a covered expatriate? That's really important because there are certain tax and paperwork consequences for covered expatriates. Typically, people want to avoid those. So we'll go over the criteria for being a covered expatriate and some exceptions to those. And then at the very end, we will talk about some planning strategies so that you can potentially avoid being an expatriate, avoid being a covered expatriate, or if you are a covered expatriate, minimize the amount of exit tax you'll have to pay. So let's get started. First, a quick overview of the expatriation rules. Now, this is kind of our roadmap that we're going to be using throughout the presentation today. At the beginning, you go into the pipeline and you're either a citizen or a long-term resident. Those are the only two types of people that can become expatriates. So if you're not a U.S. citizen and you're not a long-term resident, then none of this can apply to you. Once you're a citizen or a long-term resident and you have an expatriation event, like I mentioned before, at that point you become an expatriate. That expatriation event fixes in time a date that you use to report to the IRS when you expatriated, and the date that you report your net worth and all that stuff. Once you have an expatriation event, as I mentioned, you are now an expatriate. And if you have too much net worth or you haven't done things right on your tax returns, then you'll be a covered expatriate. And if you pass those tests, the 3 tests and the exceptions to the test, then you will be not a covered expatriate. So here on slide 9, I have a little table that is showing the differences between what you have to do if you're a covered expatriate versus not a covered expatriate. So on the left column for not covered expatriates, all expatriates are going to have to file their quote final U.S. income tax return. It might not, in fact, be their final return, but it'll be the last return where they're reporting any resident status. All expatriates are going to have to file Form 8854, and then only covered expatriates have to file the W8CE. CE is actually stands for covered expatriate. And only covered expatriates might have to pay exit tax, and only covered expatriates, when they give gifts or inheritances to U.S. citizens, those people might have to pay tax. So for the paperwork, all expatriates are going to have to file Form 8854 for the expatriation year, and all expatriates are going to have to file an income tax return for the expatriation year. That might be a dual status return, it might not be, but depending on the specifics of your situation, but in any case, a tax return will be required. And then for covered expatriates, they may have to file Form W8CE depending on what assets they have. So for covered expatriates, there are 4 big income tax rules, and these are basically the reason that you don't want to be a covered expatriate. So for 3 categories of assets, there are special rules, and then for everything else, there's a deemed sale where you have to pay tax on all the gains, sort of the unrealized gains. You pretend you sell all your assets, and then pay tax on the unrealized gains on this pretend sale. So let's go over the first 3 types of assets first. The first is specified tax deferred accounts. These are things like IRAs. These will get a deemed distribution on the date of expatriation of the full account value. So in other words, you pretend you emptied out your IRA and you have to pay tax on it as of the date of expatriation. Deferred compensation. Anything that goes into the category called ineligible deferred comp will be taxed as a deemed present value lump sum distribution. And then anything that goes into the category for eligible deferred comp gets a 30% withholding as distributions are made. Trust distributions get also get a 30% withholding on the taxable portion of trust distributions when paid. And then lastly, this is sort of the major event for a lot of people. For most people, you have to pretend you sold all your worldwide assets in this deemed sale event and then recognize the gains or losses. So you're actually paying tax on the gains as if you sold everything you owned. You do get an exclusion. The first $725,000 of gains is exempted from tax, but anything above that, you will be paying tax. And so these 4 rules kind of comprise, when people say the exit tax, this is what they're referring to. Also for covered expatriates, there is an inheritance tax. So normally when you receive an inheritance, that's not taxable to you. But if you are a U.S. person and you receive a gift or a bequest from a covered expatriate, then there's a 40% tax. And there are some exceptions to this, and there are supposed to be some regulations issued at some point in the future, but so far that has not yet happened. So we have someone who's a citizen or a long-term resident, and that person has an expatriation event. That event has to take place on a certain date, and that date is important because that's the date that you report to the IRS, and that's the date, like I said, that you use as the dividing line in your life. And you actually have to report that date on Form 8854, Part 1, Line 5, and there are 3 boxes you can check. One is for citizen, one is for long-term resident, and one is for long-term resident with dual residency in a treaty country. So we're going to talk about all three of these in a pretty good amount of detail, actually, starting with citizen. The definition or the expatriation date for citizens most of the time is going to be pretty easy to figure out. Most of the people, for instance, that I work with who are citizens and giving up their citizenship, they're people who say, I want to give up my citizenship now. It's when you get into situations where there are people who gave up their citizenship or took an act that they believed to have given up their citizenship long in the past, where we're going to run into situations where the definition of expatriation date becomes a little bit unclear. So I'll talk about what I mean about that. So first, if you're a U.S. citizen, you have U.S. nationality. And all citizens are nationals, but not all nationals are citizens. And an expatriate is a U.S. citizen who relinquishes their U.S. nationality. To relinquish means to do one of 6 voluntary acts with the intention of relinquishing U.S. nationality, and the most common of those is called renunciation. The expatriation date for people who renounce their citizenship is the earlier of 2 dates. The first is the date of renunciation. That's the date that you go before the consular official and you swear your oath of renunciation. The other date is the date that the State Department issues a certificate of loss of nationality. Now, they're not going to issue the certificate of loss of nationality before you go and swear that oath. So as far as I know, the earlier of the two is pretty much always going to be the date of renunciation. Your relinquishing act is the date that you swear the oath. That's your date of renunciation. At some point, you're going to get your certificate of loss of nationality. The IRS looks at those and says, okay, the earlier of those 2 dates. Chronologically, I'm pretty sure it's going to be the first one, the relinquishing act, so the date of renunciation. Now, it's when we get into other forms of relinquishment other than renunciation that things start to get a little bit tricky. And so for these next few slides, this is kind of the edge cases. This is situations where someone might have taken an action long ago in the past, and they believe that that was an action that caused them to give up their U.S. citizenship. In this situation, we run into a little bit of a mismatch between how the IRS sees things and how the State Department sees things. According to the IRS, the expatriation date for relinquishments other than renunciation is the earlier of the date that the individual furnishes a signed statement of voluntary relinquishment, or the date that the State Department issues a certificate of loss of nationality. So here on slide 21, I've taken the previous diagram from before and added in a third little stop sign here. So we still have our relinquishing act. We still have the date that the certificate of loss of nationality is issued. And now we also have this third event in the middle, statement submitted to State Department. So this top line, this arrow in black here that shows Internal Revenue Service, this is what they're looking at. The rule for the tax laws says to look at the earlier of these 2 dates on the right, the date the statement is submitted and the date in the certificate of loss of nationality is issued. Now, if you have a relinquishing act that happened before either of those, maybe many years before, the State Department considers you to have given up your citizenship on that earlier date, but the IRS only looks at the later of those 2 dates. This causes a problem. Let's say that in 1978, you perform an act that qualifies as relinquishment. In 2018, you file the State Department paperwork to claim that you relinquished your citizenship or your nationality in 1978. In 2018, State Department issues your certificate of loss of nationality, saying that your nationality terminated in 1978. So what's your expatriation date? We think it's 1978. And the reason we think it's 1978 is because you can't really be taxed as a US citizen unless you are a US citizen. So the fact that the IRS repealed this law that used to exist saying that you remain a citizen until you sell the State Department, it kind of implies that they realized that they can't be taxing citizens who the State Department says are not citizens. So ultimately, we have this situation where this mismatch between the State Department and the IRS causes a situation where you might have expatriated many years ago, but the IRS doesn't recognize that you expatriated many years ago. Ultimately, our opinion on this for line 5 is to use the actual Relinquishing Act date. But really, if this is your situation, like I said, this is kind of an edge case, and this is kind of something that I don't think the IRS sees a ton of this, at least not in my experience. Haven't talked to a ton of clients who have actually filed forms showing their expatriation that many years ago. So if this is a situation that you're dealing with, strongly recommend speaking with a lawyer about it. Okay, next, long-term residents. So long-term residents are a special subset of green card holders or lawful permanent residents. Basically, it means someone who has had their green card for a certain requisite amount of time. So you have the green card status plus the time criteria. And the time criteria is that you must have had your green card status in at least 8 years in the 15-year period ending with the expatriation year. And let's take a look at a diagram on the next slide. And you can see that we're talking about having the green card in at least 8 years, but in a year could mean only 1 day of that year. So really, all it takes to be a long-term resident is 6 years and 2 days. And this is what I mean by that. Let's say that you get your green card in 2012 on December 31st. So you've only had your green card for 1 day, but that counts as 1 year towards the long-term resident test because you've had your green card in the year 2012. So you count the entire year 2012 as 1 year towards the test. Then you keep the green card for 2013 all the way through 2018. And let's say that your green card status is terminated on January 1st, 2019. That means that you also had the green card in 2019. So the entire year 2019 counts towards the test. If you count up the years, you're starting with 2012 counting as 1 full year. By the time you get to January 1st, 2019, you've got 8 years. That means you meet the criteria for 8 of the last 15 years, and you are a long-term resident. Now, when you're computing the 8 in the last 15 years, when you're doing the count of your years, you do not count any years if, for one, you're not yet a long-term resident, or if you make a valid treaty election to be taxed as a non-resident for the entire calendar year. And because of the language that says in 8 of the last 15 years, the treaty election only works to exclude a year if it is for the entire calendar year. So the way this works, I've added another column into the table. And the middle column there shows the same thing as before, long-term resident, starting December 31st, 2012, that's your first year, go all the way through 2019, you get 8 years, you're a long-term resident. Now let's say instead that the same person made a treaty election to be taxed as a resident of another country in 2014. So 2012 is the first year, 2013 is the second year, 2014 doesn't get counted at all, 2015 becomes the third year, and by the time we get to 2019, our year count is only 7. So this person who made the treaty election in 2014 is not a long-term resident by the time we get to 2019. And there are 2 ways that a long-term resident can terminate their visa status. One is if the individual voluntarily gives up that status or abandons the status, and that's done by filing I-407, the form I-407. And the other way is if the government terminates permanent resident status by administrative or judicial proceedings. This one is really important. If your green card expires, that's not an action of abandonment, and that your green card has not been revoked. It's simply expired. That means that you're still a lawful permanent resident and a U.S. taxpayer. So you can have an expired green card that you can't actually use, but you're still required to file U.S. tax returns and pay tax on your worldwide income. So when you need to know your expatriation date and you're a long-term resident turning in your green card, if you're abandoning your green card, it's the day that you hand in your form I-407. If you are revoking your green card, or if your green card is being revoked, then it's the final administrative ruling date, and if you make an appeal, then it's the date that a final judicial order is issued. Now, I mentioned using treaty elections to eliminate years from the 8-year count. But what happens once you've already reached 8 years and then you make a treaty election? That actually causes you to become an expatriate. That's your expatriating event. So the term expatriate means any long-term resident of the U.S. who ceases to be a lawful permanent resident. So in other words, any long-term resident who gives up their green card or ceases to have a green card. And an individual shall cease to be treated as a lawful permanent resident if such individual commences to be treated as a resident of a foreign country under the provisions of a tax treaty, etc., etc. So in other words, you stop having the status of lawful permanent resident if you make a treaty election to be taxed as a resident of another country. Note that that only happens if you've already met the 8-year test. You have to be a long-term resident for the treaty election to cause you to not be a lawful permanent resident. If you have not yet met the 8-year test, then you're not a long-term resident, and making the treaty election only removes a year from the 8-year count. So that difference is really important when you're thinking about making treaty elections to manage your status as a long-term resident or not. So when you're a long-term resident and you're using the treaty election to expatriate, so you've already met the 8-year test and you want to make the treaty election as your expatriation event, there is some risk you have to watch out for. The date that you commence to be treated as a resident of the other country might not necessarily be January 1st. If that date is not January 1st or earlier, that means that you might be a lawful permanent resident of the U.S. in that tax year, even if only for a few days. And so that means that if you're making the election to try to avoid becoming a long-term resident and you're coming up on year 8, it's possible there could be a little unintended consequence that you might actually be expatriating by making the treaty election rather than preventing yourself from becoming a long-term resident. So let's say one way or another, either you're a citizen and you renounce your citizenship, or you're a long-term resident and you file I-407, or you're a long-term resident and you make a treaty election to be taxed as a resident of another country. One way or another, at this point, you're an expatriate. So next you need to figure out, are you a covered expatriate? And whether you're a covered expatriate depends on 3 tests. And of course, there's always exceptions to the rule. So we also have to look at a couple exceptions to see if you can avoid being a covered expatriate that way. Here's a handy little diagram here on slide 40. So going into it, we start as, like we said, you're already an expatriate and you know that. So the very first thing you look at is, are your Title 26 obligations okay? Title 26 is the tax code. So in other words, it's asking, did you file your tax returns? Did you pay your taxes, etc.? If the answer is no, none of the other tests matter, none of the exceptions matter, you automatically go right to the end, you're a covered expatriate. So this first one is really important. But let's say that you can say that you filed the tax returns you needed to file, you paid your tax, and so you're in the yes category. So next you go over to, is your net worth less than $2 million? If no, then you go down and over to the right, see if an exception applies. If not, covered expatriate. If your net worth is below $2 million and you can answer yes, then next you look at the 5-year income tax liability test. If your average tax liability is under $168,000 over the last 5 years, and you can say yes to that, then you're not a covered expatriate. But if it's over 168, then you go and look and see, does an exception apply? If not, you're a covered expatriate. If yes, then you can avoid it. So in other words, we have this kind of complicated if-then tree that we have to go through. This map is really helpful, but let's look at what's on the actual Form 8854. So in Part 2, we're looking at 6 questions here, and these 6 questions basically tell the IRS everything they need to know about whether you're a covered expatriate. The first one looks at the net income tax liability test, and you have to put on the form your U.S. income tax liability after tax credits for the 5 tax years ending before the date of expatriation. It doesn't make you compute the average, but that can be done pretty easily. So if you're putting $200,000 on all 5 of these spaces on the form, then obviously you're showing the IRS that you did not meet the income tax liability test, so that you're going to be a covered expatriate. So just a little bit of detail about this test. If your average income tax liability for the prior 5 years, that's the 5 years before your expatriation year, is greater than or equal to $168,000, then you've, quote, failed this test and you're a covered expatriate. That $168,000 number adjusts annually for inflation, so you can find the current year number pretty easily in the Form 8854 instructions, but also it gets published every year towards the end of the year. The following year's numbers get published in a revenue procedure. To actually see what your net income tax liability is, it's not purely as simple as just taking the tax liability number off your tax return. There's a couple adjustments you need to make. Some credits you don't include. So what you do is you use the rules in Section 38C1 to compute tax liability, and you do not include net investment income tax or self-employment tax. And you do get to use the foreign tax credit to reduce the tax liability. So you compute that, you add up the prior 5 years, divide by 3. If it's over 168, $168,000, then that's going to make you a covered expatriate. For married filing joint taxpayers, many people they assume that you get to divide the total tax liability by 2. That's actually not the case. Each person, when they're performing this test, each spouse in the couple has to use the total tax liability. Next is the net worth test, and this one is line 2. It just says enter your net worth on the date of your expatriation for tax purposes. So if you have a net worth greater than or equal to $2 million on the date of expatriation, that makes you a covered expatriate. Note that this number is not indexed for inflation. So this number has been the same for quite a long time. And you include all of your worldwide assets. Assets are defined as if you're giving it away, it would be a taxable gift if you were a US citizen. You also include the value of beneficial interests and trusts, and there are ways to calculate those, and you have to subtract your liabilities to get your net worth. So now we start to get into the exceptions. So the first 2 lines where we talked about the net income tax liability test and the net worth test, those 2 lines are tests where if you are a covered expatriate because of that test, that might be okay. You might still be able to be a not covered expatriate if you meet one of these exceptions. One of the exceptions is on lines 3 and 4, and one of the exceptions is on line 5. So we'll look at the dual citizen exception first. That's the one that's on line 3 and 4. The exception is if you became at birth a citizen of the United States and a citizen of another country, and as of the expatriation date, you continue to be a citizen of and are taxed as a resident of that other country, then even if you meet one of those first 2 tests for covered expatriate status, you get to be not a covered expatriate. So what does all that mean? Became a citizen at birth probably means that citizenship was automatically possible due to a fact of birth in the right circumstances, even if it took a while to do the paperwork. For example, a child born overseas to a U.S. citizen, we believe that meets the definition of became a citizen at birth, even if some paperwork had to be done after the child was born. Continues to be a citizen. We believe that means that the citizenship status has been uninterrupted since birth and taxed as a resident of such other country. What if that other country has no income tax? Is it possible to qualify for the dual citizen exception? We think so, but the way the rules are written, it's a little hard to tell. The dual citizen exception also has a residence component, and that's asked on line 4 of this section. It says, if you answered yes to question 3, have you been a resident of the United States for not more than 10 of the last 15 tax years? So essentially, you use the substantial presence test, and you apply that over a 15-year period, ending with the year of expatriation. And in that 15-year period, if you wouldn't have met the substantial presence test for 10 or more years during that period, then you get to use this exception and you would not be a covered expatriate, even if under the net worth test or the net tax liability test, you would have been covered. There is also this other exception. This is the second exception for people who are under the age of 18 and a half. And if you expatriate before you turn 18 and a half, you get to be not a covered expatriate, again, even if your net worth is too high or your net tax liability is too high. And again, just want to point out the young adult exception also has the same residency requirement with the 10-year period. And then lastly, of the three tests, we get to the certification test. Now, this test, if you fail this one, the exceptions won't help you. You will be a covered expatriate if you can't say yes to this question. So there's no exception to this one. You have to meet this test no matter what. The certification says if an individual fails to certify under penalty of perjury that he has met the requirements of this title for the 5 preceding tax years, or fails to submit such evidence of such compliance as the Secretary may require. And when they say this title, they're talking about Title 26, the United States Code. In other words, not other titles. So requirements under other titles, such as the FBAR, don't seem to fall within that. Now, what does it really mean when they're asking, just go back, when they're asking if you've met the requirements of Title 26 for the 5 preceding tax years? Everybody makes small errors on their tax returns. So can you certify full compliance with all federal tax obligations if you have a normal minor error on your tax returns? Or does the certification test only cause you to fail if you have major compliance issues? How big is major? How little is minor? Is there any kind of guidance on this? Unfortunately, there is not from the IRS, and we don't have the answers either. But we kind of have some guidelines that we follow just to ensure that we're on the right side of the line. So if you should have filed a form but didn't, so for example, especially information returns like an 8621, a 3520, a 5471, that's probably going to be a problem. You should fix that. If you did something and the non-compliance penalty is massive or creates an open statute of limitations, that's probably going to be a problem. Fix it. If you have income tax to pay, even if there's no form associated, if the income tax is, anything substantial at all, then definitely you would want to fix it. But even in situations where it's only a small amount of money, it might be a good idea to fix it, just because it wouldn't cost you much to fix it. So why not do it? Obviously, if you can be indicted for perjury, that would be a really big failure. So you would not want to say yes to the certification test if that's the case. But again, the small mistakes, don't really know. There's no sort of de minimis guidelines or anything like that on this. So what I would advise is, make sure to get it right. If you find a small mistake, usually it doesn't cost much in time or money to fix it, so you might as well just do it. Okay, so now we get to talk about ways to eliminate or reduce the damage. And what I really mean by that is pre-planning. Because if you get to a point where you've already expatriated and then you need to file your tax returns, generally at that point it's going to be too late because your situation is already fixed at that point in time on your expatriation date, and you can't go back in time and change things. So really what we're talking about is pre-planning strategies. For non-citizens, there's an easy solution here. You can just not be an expatriate. The easiest one is never get a green card. Don't become a lawful permanent resident. You can use other visa categories to live and work in the United States. Obviously, for people who have gone through that process, that's a little easier said than done, but so is getting a green card. So if expatriation is a serious concern for you, you might choose to go some other route other than getting the green card. If for some reason you do need to get the green card and you're concerned about someday becoming an expatriate, you can try to prevent long-term resident status. So you can abandon your green card status before the 8th year. So in other words, let's say you come to the US, you live and work here for 4 years. During that time, you get your green card and then you decide to leave. You can just turn in your green card. Because you haven't met the 8-year test, you don't have to worry about even being an expatriate. So there's no concern about whether you'll be a covered expatriate. You won't even have to file a Form 8854. The other option to not become an expatriate, if you have a green card, is to use treaty elections to be a non-resident in tax years before the 8th year arrives. And we've actually worked with clients in these types of situations where they've come to us and said, okay, I have a green card, I think I want to spend some time abroad, et cetera, et cetera. So they're able to use those treaty elections to be taxed as a non-resident for certain years and then come back and spend certain years in the US. And we've worked with some clients where we've managed to do some long-term planning for them, and they've moved between countries and they've managed to avoid that status. For everyone else, if you can't avoid being an expatriate, then the next thing you can try to do is at least try to avoid being a covered expatriate. You can make sure you meet the certification test. As I said, there are no exceptions for that one. So if you're an expatriate, then no matter what, you need to get your prior 5 years of tax returns in and make sure that any taxes associated are paid. If you have to deal with that late, in other words, you didn't file the returns on time each year, that can be a bit of an issue. The IRS is certainly becoming a little bit more aggressive in terms of assessing penalties for information returns and stuff like that. So that can be a little bit more of a challenge than it used to be, but the rule hasn't changed. There are still no exceptions to that test. So that may be a bigger hurdle to jump than it used to be, but it's still just as important. Other ways not to become a covered expatriate: make sure you do not meet the net income tax liability test, and make sure you do not meet the net worth test. So let's take a look at some ways to approach those issues. So one way you can do this is by managing what years you choose to file jointly and file separately if you happen to be a married person. So let's say for a number of years you've been filing jointly with your spouse, and your combined income tax liability each year is $200,000. So if that's the same forever, then at any point in time, if you look back over the prior 5 years, your average tax liability is going to be $200,000. That's going to put you over the 5-year average. Now, one thing you can do, and we've actually worked with some clients where we've used this strategy, one thing you can do is begin filing separately. And it won't necessarily cut your individual tax liability in half, like the way it's shown on this chart. It'll probably actually, in reality, be a little bit different than that. But let's say hypothetically, so you've been filing jointly for 5 years, starting in 2013 to 2017. Let's say hypothetically 2018, you start filing separately, and your individual tax liability on your separate return is $100,000. So for the filing jointly years, you had to use the combined number because you're not allowed to divide it in half. But as soon as you start filing separately, again, you use the whole number, but it's not a number that's computed from combined income from two people. So in 2018, your individual tax liability is $100,000. And so we look at the 5-year period starting in 2014. We have 4 years of 200,000, a year of 100,000, and that gives us the 5-year average of 180,000. And then if you do that again in 2019, so this will be the second year of filing separate returns. Let's say again, hypothetically, the individual tax liability for one of the spouses is $100,000. Then you have 2 years of 100,000 and 3 years of 200,000. That'll give you an average tax liability over the prior 5 years of 160,000. So that 160 is below the 168,000 threshold that exists for 2019. So that'll give you a 5-year average that if this person, this hypothetical person in this example, were to expatriate in 2019, then they would meet, or actually they would have to do it in 2020, but they would meet the net income tax liability test because they started filing separately for 2 years. Another way to avoid being covered expatriate is by looking at the net worth test. Now, you have to meet all the tests to qualify to be a non-covered expatriate, but most people who are giving up their citizenship or green card, in my experience, they've been living and working abroad at least, for a little while, and typically they are able to take advantage of foreign tax credits or foreign earned income exclusion or things like that. And between the two countries, it typically ends up that their U.S. tax liability is not all that high. So ultimately, the net tax liability test usually ends up being something that we don't need to spend a lot of time on. And where we really spend a lot of time pre-planning with our clients is the net worth test. This number is not indexed for inflation, so the 2 million threshold for this test, basically every year that number gets smaller and smaller, even though it stays the same because of the time value of money. So as time goes on, it gets harder and harder and harder for people to meet this test. So one of the major ways that we deal with this test is by advising clients to make gifts. So I have here a sort of scenario on this slide 62. We have a husband and wife. Let's say the husband is the one who wants to expatriate, and the wife, whether she's a U.S. person or a non-resident alien, in this example doesn't matter too much. So in each of these columns, the husband column and the wife column, we've listed their separate assets. And at the top is the scenario of, okay, we own everything 50-50 between us. So husband owns 1.5 million of cash, wife owns 1.5 million of cash. Husband owns 1.5 million of stock, wife owns 1.5 million of stock. The husband wants to expatriate, and when you add his cash and his stock together, he has $3 million in total assets, and let's assume that he has no liabilities to reduce this, so this would be the number that he's using for the net worth test. So right away, he fails this test. But let's say that he decides ahead of time that he wants to try and figure out, how to make this so he can be a not covered expatriate. So he's going to take 1.1 million of the cash that he has and give that to his wife. That brings his cash down to 400,000, her cash up to 2.6 million. He still keeps his stocks worth 1.5 million, and his total net worth becomes 1.9 million. Now he's not a covered expatriate. The cash that he gifted to his wife is still with the married couple. His wife's net worth now goes up to 4.1 million, and he is free to expatriate as a non-covered expatriate. So when making gifts, you do have to look at the gift tax rules pretty carefully, because there are rules for gifts between spouses. There are rules for people who are domiciled in the US, rules for people who are not. So we're going to take a look at those a little closely right now. So traditionally, interspousal gifts are not subject to gift tax. Marital deduction reduces taxable gift to 0, but that deduction is not permitted for gifts to non-citizen spouses. In that situation, you would have to use the unified credit, assuming that the spouse making the gift is a citizen or otherwise able to use the unified credit. Now, one word of caution: if you are relying on the unified credit, you need to make your gifts in one calendar year and expatriate in the following calendar year, because the amount of unified credit available depends on your citizenship or resident status on December 31st. So in the expatriation year, you'll be a non-resident, non-citizen on December 31st. Your unified credit available for gifts that year is 0, so you can't gift all of your assets relying on the unified credit and then expatriate in the same year. You'll be taking your unified credit away by doing that, and you'll end up having to pay gift tax. If you make other non-gift transfers to your spouse, you should be aware of capital gain tax risk. So this is sort of the you get my half of the house, I get your half of the bank account, value being exchanged for value, so it's not a gift. That would be treated as the expatriate's sale of his interest in the house in exchange for cash in the bank account. You might be able to solve this problem by having the non-resident alien spouse make an election under Section 6013G to be a U.S. resident for income tax purposes in the year of transfer. Another situation we see a lot is green card holders who have moved overseas, they're living abroad, and they need to reduce their net worth before giving up their green card. So we have to look at the gift tax rules that apply to them. Gift tax rules apply to U.S. citizens and residents, and in the context of gift tax, resident means that you're domiciled in the U.S. And domicile is sort of a different concept from residency. There's a different set of criteria for it. A green card holder domiciled abroad is only subject to gift tax on U.S. Real estate transfers and gifts of U.S. situs tangible personal property. So if you had your green card, moved overseas, and you're thinking about reducing your net worth, you can give away foreign assets and worldwide intangible personal property without concern for gift tax in the U.S. If that stuff is foreign. So one of the strategies we've used is when we have a green card holder living abroad, we might have that person either if they have cash in the U.S., maybe they'll move that cash overseas before gifting it to someone, so they'll move it into their own account and then later make a gift of the cash to a family member or something like that. Or if they have other assets in the US, they might first sell those assets, then move the cash proceeds overseas, then make a gift. And actually, selling the assets a lot of times can be used as a net worth reduction strategy as well. It's not actually on the slides, but I've definitely had a few clients over the years who came to me and said, you know, this asset, I know I'd like to sell it anyway, I'd like to get out of it, or I'd like to get rid of all my US assets just because I don't want to have to file US tax returns anymore, and I just kind of want to make a clean break and, you know, set up all my investments in this other country. So one potential reduction strategy is actually selling your assets and paying the tax on them. It's not always desirable, but in some cases it's certainly been very helpful for planning. So, and then for covered expatriates, what they want to do essentially is reduce their tax liability. So they can minimize their mark-to-market gain by making gifts. In other words, they would give away low basis, high capital gain assets and then keep the cash and high basis assets. So they would keep the assets with the lowest built-in gains. So that maybe that $725,000 exclusion that's available to covered expatriates, maybe they can keep their total gains below that amount, and then they wouldn't have to pay exit tax. Or maybe they can pay only a small amount of exit tax because of the exclusion and because they've managed to keep only the assets that have the lowest built-in gains. And then where exit tax is unavoidable, ensure that the foreign tax credit is available in the expatriate's home country. Typically it's not going to be, so one way to deal with that is sometimes clients will sell they'll sell certain assets that are or they'll otherwise dispose of certain assets that are going to become subject to this problem before they expatriate. So here's an example of what I mean by that. Let's say you have a US citizen who's a covered expatriate and they own a piece of real estate in France. They expatriate, so that person's going to pay mark-to-market exit tax to the US on their expatriation date for the unrealized capital gain on the French real estate. And then later, when they sell that French real estate, they'll pay tax on the capital gain in France. So sometimes people will choose to sell that real estate before they expatriate. So they'll pay the capital gain, they'll get a tax credit between the two countries, and then they'll only pay tax once. They expatriate, they no longer own the asset, so it's not a problem. And then here's a more difficult situation, because things like real estate or other assets are, usually possible to sell, not always, but usually you can find a buyer. Something like a pension, a lot of times you don't necessarily have the ability to dispose of this, and so it becomes a bit of an issue. So the situation here is you have a covered expatriate with a foreign pension. That makes it an ineligible deferred compensation item. So the pension is treated as having made a lump sum distribution to the covered expatriate of the present value of the vested pension benefits at the time of expatriation, and the US tax is paid on that pretend lump sum pension distribution. Later on, the former US citizen retires, starts receiving pension distributions, and the distributions are taxed by the home country of the former US citizen. So in situations like that, between the US tax that they pay at the time of expatriation and the tax they pay in the other country when they actually take the pension distributions, the tax rate can be extremely high. So these are some issues that we see that may or may not have solutions, but these are the things that clients generally choose to talk to their tax advisors and their lawyers about, to see if they might be able to find any solutions. There is one country where this is a solved issue, Canada. So if Canadians come to the US, they can make an election for US tax purposes that'll allow them to eliminate double taxation on assets that were subject to Canadian departure tax. So Canada also has sort of a exit tax type thing like the US. And the Canada-US Income Tax Treaty allows expatriating Americans in Canada to get the same double taxation relief. So effectively, there's a fake sale in both countries, allowing foreign tax credit to be used and giving a basis step up. So at least with one other country, we've solved the double tax problem. All right, so thanks everybody for listening. Just a quick disclaimer, not legal or tax advice. Don't use this presentation to avoid penalties. Hire someone if you need legal or tax advice. Thank you, everybody, for participating. Next month's session will be February 14th, presented by Phil Hodgen. The topic will be choosing a holding structure for investment in U.S. real estate by non-residents. If you're not on the mailing list for these, go ahead and sign up, get the announcement emails for upcoming international tax lunch topics. You can go to hodgen.com/newsletters to sign up for that. And if you're already on the mailing list, please tell your friends, and we'll see you again next month.